Thank you, Sunil. So let's talk about some early stage capital and how would we go about raising the initial bootstrapping and getting some of the funds. Of course, we expect that you've put in some funds first before you've gone for other people's money, so your skin is in the game. But you could have put in 5 lakhs, 10 lakhs, 20 lakhs, 30 lakhs, 50 lakhs, whatever that is. At some point, you're saying, my business needs more. And so you go to friends and family. And then you go to what we call angel investors. Once you're starting to look at 25 lakhs, 50 lakhs, you start to hit the angel investors. And then, there's a lot of angel networks that you go to. So I'm going to ask Anurag maybe to talk a little bit about what different kinds of funding is available. There is angel networks, there's incubation, etc. But how do you look at these different forms of funding? How does a very early stage company look around and say, how do I get my capital?
Okay, so Ananth, you already answered the question even before asking it. So I think he's already named the usual suspects. I think one thing I would suggest based on our experiences that, and I think my co-panelist Sunil also mentioned it, that ideally if you can do without the venture funds or external investors, the best way is to bootstrap. I think all investors, any external investor who would even look at your company would see what is your skin in the game. And sometimes that skin in the game comes in the form of your own capital. Sometimes it just comes in terms of what you've foregone. So opportunity cost, or what you are giving up for that, or how you're sort of tying yourself up with. And of course, as you sort of extend, taking money from friends and families can be extremely tricky. And also, when you raise money at an early stage, what happens is that you end up diluting quite a bit of equity. So equity is not the cheapest source of money. It is the most expensive source of money. Even though you're not paying an interest on that, it's obviously you're giving away a part of your company. And assuming that it's going to be a valuable company, the likely cost of that equity is going to be much more than any debt. So if you can get your financing through some debt options, that's ideal. Also, if you could maybe fine tune your business model to ensure that it's generating positive cash flows from a very early stage as opposed to burning a lot of cash. But again, it depends on the business model. So some of the businesses do need that infrastructure or upfront investments, and sometimes there is this talk about money coming to a strong team, and to put that team together, again, there is certain investments, and that contribution of money can also come from the team. So one of the things that we did as we were sort of growing in Telecap was that all of us who came from corporate backgrounds took significant pay cuts, which was in some sense our investment in kind, but we also invested our own savings, etc., at a very early stage, which not only created the ownership, and then when the investor, and a very high profile investor, the investor who was the largest FDI investor in India a few years back, was looking at us, that was a very important component, that skin in the game of not just the founder, but the larger team. So I think if you can create that ownership from your team, then it gives more confidence, and not just ownership, but also actual capital contribution coming in from people who are part of the setup and who are invested in it for the long term. Of course, then you can do the rounds of the angel and VC funds, but I think that they all look for that commitment upfront from your side, and the fact that you've made an effort to make that money run for a long time. There is also the requirement that what is the efficiency on that capital? So how far you are able to leverage that capital. So seeking external capital and running a business is not the easy solution. It's something that you should try and avoid as much as possible. That's what
yeah, one thing I would like to add, before trying to dilute your equity, or before asking for funds, or before trying to raise the funds, first of all, you think like as an investor. That if as an investor, I would have to invest in this company, whether I should invest in that company or not. And you will get the answer. Just for going for the funds and starting the company and thinking of subsidy and all those things, these things will not work. You should have a very good business model. You should feel that this business model is to go long. Normally what we are finding, that people are having herd mentality. One person has entered into one business and he has become successful, and other people start following. Now I am seeing that a lot of people jumping into e-governance. They think that because Google and Flipkart and all these people have got huge valuations, so they are also going to get a good valuation. They form e-governance company, and after 3 years, they will sell the company. No, if these things start happening, you should understand that no, this is a setting sun. Okay, no, you should not invest in this type of company. Better run away out of this company. Okay. So another thing, from a stock exchange angle, we are not thinking from a type of company which can give 25% return, 30% return. For last 15, 20 years, I feel that whatever the growth that India has seen, it's more because of the service sector, which is not the largest employment generator. No, people have stopped thinking about the manufacturing company, people have stopped thinking about the agriculture sector, and that's why we are seeing a lot of food inflation going on. And the currency depreciation which we are seeing as of now. I think we, as a stock exchange, we see all the companies, whether it's a manufacturing company, whether it's a service sector, and whatever it may be. So, of course, what my friend Anurag has said, that equity is not a cheap source of raising funds. But frankly speaking, what I had observed from the stock exchange angle is equity is the cheapest source of raising funds. Let me tell you, if your company is not listed, not tomorrow if your market capitalization becomes 1,000 crore and you are holding 60%, at least you are the owner of 600 crores of company. So better dilute the equity. If you have got the confidence in your company, better dilute it. If you don't have the confidence in your company, then go and keep on cheating the banks and pull the venture funds or PE funds. Otherwise, better go and list your company.
I think that's very well said. Consistency is what they reward, definitely. But one means of finance for a startup. See, we meet a lot of entrepreneurs and we talk to a lot of successful entrepreneurs. And we do ask them, how did they get their first funding? And the brightest, which comes with the biggest of smile, is that I got my first advance check from the customer. My customer paid me the money and I was profitable within first few months. That there is no better validation that if the customer is prepared to make an advance payment, and that's how multiple businesses have started and become successful over the years.
Fantastic point. I was saying there's debt, there is equity, but if your customer funds you, he said two things. One, they validate your idea, and two, that's the right way. I mean, that's the right way to get it going. I saw some gentleman there with a question, so let's take that.
Okay, obviously he's asking what is the rate of return that an angel investor or a venture capital expects from an entrepreneur. Well, I can only smile. The people who invest in my fund, they expect that I'll give them 10 times the money in a period of 5 to 6 years. The worst case, they expect 5 times I'll return. Now, if I have to return 5 times with my expenses or so, the money has to become 6, 7 times. That's the kind of return that we expect. That means you cannot calculate as 10%, 15%, 20%. The return expectation is beyond 35% by we people, beyond. And when we look for businesses, we look for businesses where the possibility is there for money to become 100 times as well. You will meet many angel investors who say, there is no possibility of becoming it 100 times, so I'm not even looking at this venture. I took one venture in the initial phases of my career as an angel investor around 4 years ago to an angel network. And I presented a thing that this will become 10 times in next 3 years. But there is no possibility of it becoming 100 times, so please don't talk to us. I said, fine, thank you, sir.
I think I just want to add a little...
Excuse me. So what is the minimum limitations you are expecting?
Minimum?
Yeah. Minimum growth, what are your expectations?
Minimum 5 times in 5 years.
In 5 years.
Minimum. But that is very, very low, yeah?
I just want to add a clarificatory point here that, based on our interactions with several entrepreneurs, sometimes people just miss the fact that this return that the investor is expecting is not necessarily the return that you will pay out as a coupon from the business. It's basically going to come from the growth of the business and somebody else who's looking to invest at a higher value who provides the exit to that investor. So I think that's a very important distinction, whereas in a lending situation, it's the cash flows of the business that have to support that cash outflow. Whereas in an equity situation, you have to either grow the business and grow it to that 5x, 10x, or 100x, or it can become zero also. So the investor swims or sinks with you.
A stock market will not ask you for the return. Their value will created on its own. The market is liquid, value will get created on its own. But in a stock market, what we have observed, when there is a bull market, they along with horses, donkey also get sold. But when it's a bear market, then horses are also finding it difficult to get sold.
Any other questions from the audience? Wait, give them.
Hello, sir.
There's one here. One here, yourself. Yeah, please.
This question is for Mr. Ajay, sir. Like BSc, MSc is a great platform, but I have seen that most of the companies are in losses. Like once they are listed, they are in losses. So most of them are in losses. So what do you think about that? Because the compliance standards have been lowered, so they are in losses.
Sir, from where you had got this extraordinary figure?
No, I monitor.
Sir, please give me that figure. I am really shocked. I feel that I am not working in the stock exchange, sir. I don't know from where you had got this figure.
Recently, I would say maybe
this figure is totally wrong. Do you think that India is full of people here? 80 lakh crore of market capitalization. Are they going to give the loss-making company? Please, yeah.
And second thing is that the minimum application size for the IPO of SME is like above 1 lakh generally.
Right. It's above 1 lakh rupees only because we want the informed investors to invest in the companies. Okay. That's why we have kept it 1 lakh. So that, see, a stock market is a high risk, high reward type of thing. Not only a stock market. In fact, equity investment is itself a high risk and high reward type of thing. Okay, so we want the informed investor who understand the company, who have got deep pockets and who don't disturb the company to invest in this type of company, who have got deep pockets. That's why we have kept it at 1 lakh. We don't want the people, because in the stock market, what we have seen that many of the retail investors don't understand the company and they invest. We want here the informed investors who come, understand the company, understand the risk-reward ratio, and then only invest in these companies. And once the company grows big, after 2 years, you can migrate to the main board, and then you can sell your shares and get a good return.
Thank you.
There was another question here. Yeah.
I had actually 2-3 questions, so I'll put them one by one. Number one was, I think somebody said that debt should be preferable to equity because long-term equity is more costly. However, at the early stages of a company, when you go to an angel, you're probably looking for them to get their skin in the game as well. And therefore, at that stage, wouldn't you want somebody to take a bit of equity, because then he's got, as you said, his skin in the game.
I got the question.
The second question was that is there a preferred exit option for angels, like whether they prefer an acquisition in 4 years or an IPO in 7 years? I mean, what is it, or is it case by case basis?
Okay, very good observation. Yes, in theory, debt is cheaper than equity, but debt can be taken only when your revenues are consistent and you will be able to service the debt with loan repayment as well as the interest from your revenues and income. Until then, do not take the risk of financial leverage. We call the leverage of 2 times. One is operating leverage. Because your business is not certain as of now, you've just started. Operating leverage, operating risk of business is already very high. At that time, please do not take additional risk of debt and debt repayment onto your head. At that time, it is better to take equity. It may look expensive, but as Ajay said, it is very, very economical, because it's not going, the cost of servicing of the equity is not going from your balance sheet. Somebody else will come and buy that equity from the investor. You don't have to pay for that. You don't have to service that. We look for exits. On the exit side, preferably the exit is from a strategic buyer. Your business should be such that some large company, some bigger company, somebody who wants to enter into India, somebody who wants to expand the idea, somebody who thinks that in their business they were not able to innovate enough, and now you've done an innovation, would like to acquire you. Once they acquire you, that's the time we sell out part of our shareholding or most of our shareholding, and you may sell part of your shareholding and become a part of the team there, or retain some of the equity. That's the best route. Listing, yes, is there. Thanks to the small exchange, that we can now dream of that. Earlier, it was just not possible.
Sir, if you ask me, I feel that if you have, again, I am reiterating the same thing, that if you think that the company is in the growing path, better go for equity. I have seen most of the companies dying of debt then because of equity. This is what I had seen. So I think, you should have a balance between debt and equity. It's not that you should completely depend upon equity, at the same time you should not completely dependent on debt. No, debt and equity are two wheels of the same cart. So better you should have a balance between debt and equity, and then you can grow your company.
Yeah, it's also a mix of, while the mic comes to you, it's also a mix of high risk, high return versus a specific return. Debtor is expecting a certain amount of return. So if you have, as he said, consistent operating cash flow, then debt is a good idea. If you're seeing a high growth potential, not proven yet, then equity could be a good idea. At the end of the day, you want to make sure the right amount of funds are in the business. And that's what drives, to some extent, equity dilution. And so while equity is important, it's more important to make sure there's enough funds in the business.
Yeah, I just wanted to make an additional point. So as an entrepreneur, one of the things that you are trying to optimize is the value of your ownership in that enterprise. And sometimes what helps, and again, I'm mostly an equity guy, so I'm on this panel almost supporting debt. But one of the things that helps is that if you are able to finance your business through debt for a period of time, you're able to take it to that next stage of growth, at which point if you raise equity, you own more of that business and you're able to sell whatever portion of that equity at a higher price. So again, it's a fine balancing act. If you take on too much debt early at an early stage which you cannot service, then your business itself may not survive. But at the same time, and again, the point that you were making about angels coming in with money, but more than money, it's the value that they can bring on the table from their experience. So that is probably more, more valuable than even the money that they bring on board. So
smart equity, as it's called. I mean, if people who can come in with equity or also can contribute to your company, whether in terms of advice, strategy, contacts, network, whatever it is, that's huge value add.
And the day the smart money is not required, the day you don't need that advice, mentoring, reach out, you can go and list there. Anybody can own your share, it doesn't matter.
Please try to understand. Till the time you are not listed, you are a local company. The time you get listed, everybody looks BSc here. Please come on. Nobody sees parliament that much of time, then they see the BSc building. So please try to understand the companies which are getting listed there, how much exposure they are going to get. Please.
That's true. That is true, but yeah.
Yeah.
There's a question here, please.
Yeah, as sir told that it should be a fine balance between debt and equity, but in an initial stage, if the company has some debt or will it not hinder in the way of investors? Will they love a company with debt, or they would like to, because the burden will also be adding on to the company and the profitability will go low?
See, I'll tell you, fundamentally, debt has first preference in terms of taking out the money in most cases. And so, in some sense, any equity holder knows he is now second priority when cash flows come in. So it is a hindrance, but I don't think that is in itself a deterrent for an investor to invest.
Yes,
right?
yes.
That is only if the company is producing 100 rupees cash flow and the debt is 10 bucks or even 1,000 bucks, he'll probably put it in that context. He'll value the company differently depending on how debt heavy you are, but it is not against or for if it is there. But it also means that if there is a good amount of debt on your books, there's someone who's done diligence on you, especially if you're going for your first equity. Someone who has done diligence on you, thinks that you have enough cash flow to repay that, itself is a strong statement for you as a credibility of the organization in terms of getting your first equity raise.
yes,
Thank
so,
you.
the other thing that happens is that the moment an investor comes into your company, he is now on the same boat as you, right? And so the option for that investor is the same as what the investor is trying to also do is to maximize their value. And again, when they have to choose between the next round of equity versus debt, it's a choice between dilution of that ownership versus that additional risk or the cash flow drain or stress that you're taking on. So again, it's very, very contextual to a business. As an equity investor, I would want my my equity to go as far as possible. So if let's say a business is at point X, can it go to 10x with the same equity? Can it go to 100x with the same equity? Or if I'm restricting, or by taking on that additional debt instead of equity, is it restricted to only 10x instead of going to 100x? So it's that value game again, and you're trying to constantly figure out how do you optimize on that.
And debt is never a deterrent till the time your company is over leveraged. The time ati sarvatra varjit. So the time you take a huge debt and their cash flow is becoming negative, then it will be a perennial problem. So you have to just look into that.
Good
one
question here. Yeah, please go ahead, front row.
Actually, I'm a doctor and I have some health plan. But apart from this, all this business talking, the debt, the having a concept of marketing, advertising, and all that before you start the business, one cannot have all this. I have just an idea. So suppose I want to get a fund for my project, and that you said first you buy your customer, they will be best investors. But before that thing can come, I have to launch it. People should see it, accept it. So how can you help us in advertising and making it feasible? Because I was talking to the investors above. They said this is too grand an idea, too maybe practical or not acceptable by the investors because the lag-in period will be long and return will be not quick. So how do you help in these matters?
I think that's a difficult question to answer in terms of how anyone can help, but I'm sure all of us would be happy to look at what your business plan is.
In short, so can I describe it? Just in short, I'll just tell you.
Let me suggest,
okay.
we'll take that offline. In fact, all of them will be around, except him running to the airport right now. But at least they'll be around for 3-5 minutes, so you can probably take it one-on-one.
Yeah.
The specific questions? Oh yeah, I know you wanted another question from them.
Actually, I just want to know how much time does it take to get listed with BSE SME, and how easy is that?
It's very easy and it takes 3 months for your company to get listed. I will share my visiting card with you. Please call me anytime.
Thank you.
Let's know what the stock is in 3 months from now.
Share with everyone so that everyone can notice.
You have a question there?
There are some other instruments of investing which are called quasi-equity, wherein it is convertible bonds. Is there a preferred method for angels, or is that something that is looked at in very rare cases?
You want to try that?
Yeah. So I mean, usually what happens is that as an entrepreneur, you're very optimistic about your business, and as an investor's job is to question and find potential risks or obstacles there. So usually there is a gap between how you see your business going forward versus an investor. And sometimes these instruments are used as a bridge. So usually a forward-looking business plan, subject to certain milestones, the valuation, etc., is fixed. So usually these instruments are used to bridge that gap, and they are quite commonly used. Compulsory convertible preference shares, compulsory convertible debentures, etc. So it's actually probably sometimes even more used than common equity.
It's basically a point where valuation gets determined a little bit later. Until then,
and it's not just valuation. Sometimes it's tranching of money. It's subject to certain milestones, including hiring a person or setting up a plant. So it could be multiple subjective things as well.
Okay, we have our timers up, board running there. So I want to, first of all, thank you all for being patient through this session and listening out. I really want to thank Sunil, Ajay, and Anurag for taking time off from their businesses and being here to, to join us. Thank you very much, and appreciate you all coming down.
Thank you, Dev.